You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. I'm joined by my co-host, John McEwen. It's the 13th of March, 2023. And in this week's episode, we'll be discussing primary health properties, Rightmove, Persimmon, London Stock Exchange, AB InBev, and our US company of the week is Wendy's. John, shall we start with primary health properties?
Yeah, it's one we've covered before, and it's the Primary Care Real Estate Trust, or one of them, that's listed on the FTSE 100. I think second biggest, actually, Assura being the largest. Anyway, they had their full year results out recently with net rental income of £141.5 million, up 2.4% on a like-for-like basis, driven by rent reviews agreed between 2018 and 2020. Underlying earnings were up 6.6% to £88.7 million, benefiting from growth in rental income as well as a lower interest rate. These were achieved by the refinancing made between 2021 and early 2022, which locked in favourable rates. Cash flow from operation was down from £140.4 million to £117.6 million, reflecting a reversal in last year's increase in accounts payable. Net debt grew £61.8 million to £1.26 billion, with continued investment into the property portfolio. This had begun to slow in the second half, with rates rising and with the wider economic outlook worsening. The group remain confident that their rental income can benefit from the inflationary environment through inflationary-linked rent reviews. The company also implied that open market negotiations could boost rental income as the NHS seeks to deliver larger primary care facilities and modernise the existing estate. Total dividends for the year increased by 4.8% to 6.5 pence, which is the 27th consecutive year of dividend increases. In terms of valuation, Primary Health Properties has a market cap of just under £1.4 billion and trades at just 1.1 times forward price to book, which is broadly in line with its 10-year average, and it currently yields over 5%. I thought these results were steady, as is the business as a whole, which maintains 99% rent collection rates, with the rent essentially being paid by the government. It also has strong fundamentals with an ageing population, younger GPs not wanting to own surgeries and preferring to lease, and the fact that 40% of primary health facilities are not fit for purpose. One thing that would worry me about primary health properties, I mean, there is the debt, but we've discussed that before, and I think, Sam, you felt that it wasn't too high, given that the nature of the business and that it's effectively underwritten by the government. But one thing that would worry me is what a new government that might potentially nationalise general practice would mean for a company like Primary Health Properties. I certainly don't think it would be as worrying as when John McDonnell and Jeremy Corbyn were talking about it, which might have been more of an asset grab with little or no recompense. But the Shadow Health Secretary has been talking about nationalising general practice, and I don't know how Primary Health Properties would feature in that, if they would be comfortable with a private company essentially providing the buildings in which the NHS might operate in, or whether they would intend to sort of buy them out. And I suppose the price at which they buy them out would be, I'm sure, contested. So that would worry me slightly, much less than it would have done 5 years ago, but that would be a slight concern. Overall, though, I think opportunity cost would be the main reason that I wouldn't. It's not the sort of company I'd really like to invest in, but I can think of far worse, and I can think of ones in terms of property real estate investment trusts that would be a lot more volatile and have certainly couldn't boast of rent collection rates of 99%. So I think you could do a lot worse. Sam, what are your thoughts on these numbers and primary properties or primary health properties as a whole?
I think the numbers are pretty decent. The rent collection figure that you said, 99%, that's really the standout figure. There's very few. Well, most rental businesses would kill for that, wouldn't they? I think it seems like they've got some pretty shrewd operators in management. I like that they refinanced in 2021 and early 2022 and locked in favourable rates. However, I'm not sure about then using that to carry on investing in the portfolio. I think they would have been better almost keeping that as a war chest so that when they did start having renewals, they're in a good position. How does the inflation-linked rent review actually work in practice? So you say it's underwritten by the government. Is that effectively being paid, though, by the surgeries themselves? And if so, does that mean that the doctors are actually the ones paying for it, even though they're not necessarily getting inflation-linked pay rises?
I think it would cut. Now, my understanding is that it would still come. Essentially, it would still come from the government if the rates did go up. That's my understanding, but I think they'd have to have a review prior to that to agree that it was sort of essentially a fair. But my understanding is it would be reimbursed.
Okay, so say for example, you've got one that comes to renew. The doctors aren't really getting paid anymore, and then the rent's going up by 6%, which probably seems pretty reasonable in this environment. That 6% comes from the government rather than from the doctor's share of the profits.
That would be my understanding.
Okay.
I'll have to. I may have
it's
to.
It's more for my own point of
interest
afterwards, but that's fine. It's just a point of interest, really. It's not. It doesn't really matter because I just wouldn't really invest in a REIT. But yeah, it's a pretty solid business. I'm not. I think the debt's sort of all right, but at the same time, it's still big. Yeah, it's still a lot. Yeah, it's not really got much more to say on it because I just wouldn't ever consider investing in it. Although it does, there are certain elements of it that I would find attractive. Although not the debt.
Yeah, no. I mean, some of the fundamentals are very good in terms of the fact that you don't have doctors wanting to own them; they just want to lease them, and this is essentially one of the biggest leases there is, and that you've got an aging population. And that the existing stock is not very good for the most part. So it certainly does have a lot going for it. But in the low interest rate environment, you can see why it would have been, great for a company like this. And then creeps up, and it's going to be more challenging, I would have thought. And what they mentioned, how much they can pass that on will be tested.
Say in theory, if all the contracts are inflation linked, then really the interest rates are going to go up with inflation.
Yeah.
So they might sit there and say, well, actually, we're not bothered about the debt because it's backed by the government.
And
although if we're getting higher interest rates, we're going to get higher inflation. It's because we've got higher inflation. So we're going to get it back.
Yeah, that's true. That is true. That is true. We'll see whether that works in practice.
Well, yeah.
It's fine. Okay. On to another different type of property company, or is it a tech company, Sam?
I'd count it as a property. I'd put it in the property. We've got a bit of a property theme on the first half of the show. So for that reason, it will be a property company. So Rightmove, I'm sure they don't need an introduction. The property platform, they have come out with their full year results, and revenue was up 9% to 332.6 million. Operating profit was up 7% to 241.3 million. Total dividend was up 9% to 8.5p a share. Basic earnings per share was up 10% to 23.4p a share. So they've said the revenue increase of 9% was due to customers continuing to upgrade their packages and to increase their use of digital products. They've highlighted they returned 197.7 million of cash to shareholders through buybacks and dividends during 2022. And that's on a market cap of 4.41 billion. So it's about 4.5% of the market cap was returned to shareholders. They've highlighted that the average revenue per advertiser was up 11% to £1,314 per month. And that's the second highest year ever for absolute average revenue per advertiser growth. Total membership was flat at 19,014, and that compares to 18,969, with agency branches down 178 and new home developments up 223. They've said they've had resilient traffic despite a significantly less frenetic property market than 2021, with a total of 16.3 billion minutes spent on the platform in the year. That compares to 18.3 in 2021. Time on the platform was 34% higher than the pre-pandemic record of 2019. So this is quite interesting. So the number of agents has actually declined in the 6 months. However, the new homes has gone up. So what we saw last couple of times we covered it is because the property market was absolutely booming away. A lot of the new developers had said, well, actually, we're not going to pay these fees because we don't need to, because we've got more demand than we can possibly accommodate. So a lot of the newer developers dropped off. So you can see 2020 to 21, the number of new developers on the platform dropped from 3,275 to 2,859. It's now back up to 3,082. Whereas the agency fees number of agents is basically flat. So that's 15,922 in 2020, up to 16,110, and then down to 15,932. So, all those new developers that have dropped off are now coming back, which is also quite an interesting insight into the property market, isn't it, as well? So they've said compared to 2019, transactions were up 7% and average asking prices were up almost 20%. And unfortunately, they've shown the graph in the slides of the market share of the top 4 property portals, which are Rightmove, Zoopla, On the Market, and Prime Location. Rightmove in 2018 is actually at about 80%. And it looks like that goes up to about 90%, and then it's dropped, but it's above 80%. Unfortunately, because of the way they've shown it, they've not actually shown the final percentages. So unless I want to get my ruler out, I can't see what it actually is. But it looks like it has gone up since 2018. Zoopla seems to have dropped off quite a bit. So that was about just under 20%. It seems to be closer to 10 now. On the Market, which we actually covered a couple of years ago, I think, or maybe 1 year ago, that's a couple of percent. And then Prime Location, that's very small. I've not even heard of that. But yeah, it's basically a monopoly, and it actually looks like in the long term, its share might actually be getting bigger, which is always nice. So in terms of the valuation, the business trades at a PE ratio of 22.72 and has a dividend yield of 1.59%. However, if you include the buybacks, that yield is actually a fair bit higher. I think at a PE of 22.72, I think that's pretty reasonable. I actually think this is a less cyclical business than we might have previously considered, because as agencies drop off, you're going to get the new developers coming on. But also the only time we've seen any cyclicality with this business is when we had the COVID hit and it dropped the prices so that the agencies didn't go bust. I think that was a one-off. I think in the next recession, you can expect them to maintain the prices. And I don't think Rightmove will be hit anywhere near as badly as the actual property market would be in a downturn. I think at 22 times earnings, it's not cheap, but for a business of this quality, and I do think there should be some premium for the fact it's a monopoly, I think it's pretty reasonable. My only complaint is the same as last time. I don't know why they haven't gone out and bought Spare Room, because I think that app would fit in absolutely perfectly.
I would agree. Do you still own shares? I
do. I'm very happy.
Yeah,
I might add to it, actually. It's because it's not that expensive. I think, well, it is expensive, but we've seen it at 25, 30 times earnings in the last couple of years. It's not really done much, but the earnings have carried on going up, so it's starting to grow into its valuation. But it's just such a high quality business.
Yeah, I think is it 2020 I bought shares? I don't know, but that I haven't seen much happen with the share. Not that I look at it regularly. I think it had a bit of a run in 2021, and then it's just sort of cooled off. But like you say, the numbers that it's putting out haven't. So it's becoming a better and better business. It's been growing into that valuation. And
the number of shares is coming down as well.
Yeah, yeah, absolutely. So yeah, no, happy shareholders. I think both of us.
Should we move from the platform to the developer?
Yeah, not so, well. I don't know. I'm not a Persimmon shareholder, but it's the York-based house builder. They had their full year results out recently, with the total group revenues up 6% to £3.8 billion, as completions rose by 2% to 14,868 homes, with average selling prices increasing 5% to £248,000. Underlying operating profit also increased by 4%, as careful cost management helped mitigate build cost inflation, which hovered between 8 and 10%. Critically, though, this figure excludes a £275 million adjustment related to the anticipated costs for removing all of the combustible cladding. Net cash fell from £1.2 billion to £851 million, with inventories increasing and free cash flow more than halved to £373 million. Sales rates did increase in the first 8 weeks of 2023 to 0.52, but this is well down from the 0.96 in early 2022. Full year completions are now expected to be in the region of between 8 and 9,000, and the final dividend of 60p was announced, but that represents a cut of 74%. In terms of valuation, Persimmon has a market cap of just under £4 billion and trades at a forward price to book of 1.28, which is below its 10-year average of 2.12. As we've said before, you're really beginning to see things cool off in the housing market, with a wider market slowdown and rising interest rates, which are getting significantly higher and may be for a prolonged period. And interestingly, analyst consensus is suggesting a 34% potential fall in revenue this year for Persimmon, with inflationary pressures putting operating margins under pressure and pushing them down from 26% to 20%. I'm invested in another house builder, Redrow, which is the story, well, not dissimilar. Plan to stick with it despite the headwinds. I think the fundamentals of the market for the long term are strong, but I don't think we've seen the worst of things yet. And I think you're certainly going to be, as you suggested, Sam, more exposed in the property cycle with the house builders compared with Rightmove. You're somewhat insulated from it with Rightmove. What are your thoughts on the house builders at the moment? Persimmon, any of them, would you be buying shares or considering a position?
I think these results are fairly all right. I think the problem is, though, it's only more recently that things have started to decline. So I think these full year results.
Full year.
Yeah, so it's still, things were pretty rosy at the start of 2022 for the house builders. I think as well, one thing we've noticed when we've been covering sort of the interim results is, although things have been slowing down, they've had such a strong order book going into this that the full effect's not coming through in the results yet, because that order book, they're just working through it. So they've just got a smaller order book at the minute. That's the main impact. 2023, however, they've already used a lot of the order book, and I think that'll be really interesting to see. However, this is a business that's had, a dividend cut of 74%, and it's still yielding 6.5% perspective of the next 12 months, which tells you how cheap it had gotten. And the thing is, it's like, if you don't mind the pain, if you're getting it at this stage in the cycle when everyone's got doom and gloom, and then when things are back, I appreciate the share price. I mean, it's fantastic for you, but the share price is going to go back up as well. But on a cost basis, you could be getting a dividend yield within a few years of like 25%. Now, it's not actually what you're going to be getting, because the share price will go up with it and bring the yield down. But if you don't mind the pain and you've got the time to wait, I don't think you could. I think you could do a lot worse than looking at some of the house builders, because there are some very, very good ones. I don't think Persimmon would be my choice, though. I think of the house builders we've seen, it's probably been my least favourite, and it's probably got the worst reputation. For example, with the combustible cladding, they do have a reputation for poor build quality compared to some of the others. I used to know someone that worked in conveyancing, and this is anecdotal, but they used to say that the Persimmon houses were crap. Like, it's just, and that is very anecdotal. But if you compare that to some of the others, like Red Row, which I think you've got, seems like a very, very good operator. Taylor Wimpey, where they went out and bought all the land, basically the COVID bottom, which at the time I disagreed with, but but in hindsight, they made the right decision. Whereas Persimmon, I think you've got so many options out there that I've never just seen anything from Persimmon that's particularly inspired me, that if I was to get a house builder, it would be my pick. I'd probably go for one of, Red Row or Taylor Wimpey, I think. So, yeah.
Yeah, no, fair enough. Okay. Moving on, London Stock Exchange.
Yes, it's a business we've covered, I think, once before. I think I struggle to understand it. I can't say I've fared much better this time around. It's actually one where in my interview with Steve Daniels, that is the last two, well, not the last two, but in one of the recent episodes, two of the recent episodes, I interviewed a guy called Steve Daniels from the Playing Footsie podcast, and he's got London Stock Exchange in his portfolio, and he made quite a good explanation of why he likes it. But I find this quite a difficult business to understand. It's just too complicated for me. Anyway, they have come out with their full year results, and I'm sure you're all aware of the London Stock Exchange, because if you're listening to a podcast covering UK listed stocks and shares, at some point you have probably bought a stock that's listed on it. So their income for the year is up 18.5% to 7.74 billion. Their operating profit is up 33.1% to 1.4 billion. Their earnings per share is up 65.3% to 141 million. And their dividend per share is up 12.6% to 107 million. They've adjusted their figures, and they've adjusted them downwards, which suggests that we should pay attention to them. But their adjusted operating profit was actually only up 19.5% to 2.7 billion. And their adjusted earnings per share was actually only up 16.7% to 317 million, but still very respectable figures. In the financial highlights, they've said that they've had broad-based data. Their broad-based growth has been data analytics is up 4.2%, and that's up 5.3% excluding Russia and Ukraine. Their capital markets segment was up 9.8%, and their post-trade segment was up 7.5%. So all three segments have grown. In the strategic progress and outlook, they've highlighted strong and consistent execution of the Refinitiv integration, trading and banking return to growth. Target 2022 run rate synergies were delivered for both revenue and costs. Run rate revenue synergy target raised from 225 to 350 to 400 million by 2025. They've highlighted their significant shareholder returns. 300 million of a 750 million pound buyback was executed in 2022, with the balance to be completed in July 2023. However, that's on a market cap of 40 billion, so that's not really, you're talking a couple of percent over 2 years there. The full year dividend was up 12.6% to 107p. Their new guidance for 2023 is constant currency revenue growth of between 6 and 8%, adjusted EBITDA margin of 48%, business as usual CapEx of approximately 750 million. In the slides, they've highlighted, so they're talking about their targets. They've currently got an EBITDA margin of 47.8%, and they've targeted at least 50% by the end of 2023. They've currently got revenue synergies of 68 million, and they're targeting 300 on a run rate basis, and that they're targeting 350 to 400 million on a run rate basis by the end of 2025. And that's a target that's been raised. And they've also got cost synergies of 297 million on a run rate basis, and they're targeting over 400 million by the end of 2025. Interestingly, they've got over 1 billion of amortization included in those results. And a lot of that is on the impairment of purchased intangible assets. So what that means is when they've done quite a few acquisitions. For example, they've done the big Refinitiv acquisition. And when they've purchased that, their intangible assets have gone onto their balance sheet, and basically they're allowed to amortize those. So it reduces the profits. So that's an expense in the accounts of over 1 billion a year. However, there's no cash flowing out for that. Although the cash already has flown out when they bought the business. However, that means that you are getting depressed operating profits compared to the actual cash that this business is bringing in. And that shows because the business currently has 979 million of profit from continuing operations. When you add back the depreciation, amortization and impairments, you add in back another 1.89 billion. There's other items that work out in their favour of 600 million, and then there's working capital outflows of 200 million. And that gets you to operating cash flow of 3.2 billion, which is significantly higher than the profit figure of 979 million. Then you've got interest and royalties, taxes, capex, and that stuff. And then you end up with an equity free cash flow of 1.6 billion, which is still significantly higher than the profit of 900 million. And they've also given, so it's quite a diversified business, but they've given their total income by geography, and 46% of their income comes from the Americas, 39% from Asia, and 15% from Europe, Middle East, and Africa. By currency, 57% of revenues US dollar, 18% to the pound sterling, 17% to euro, and 8% other. And by currency, total costs by currency are 50% US dollar, 26% pound, 11% euro, and 13% other. In terms of the valuation, the business trades at a PE ratio of 23.17 and has a dividend yield of 1.47%. One of the things that Steve Daniels mentioned in our recent interview was that the earnings are basically depressed at the minute because of all the extra costs they've got from the Refinitiv acquisition. And once a lot of those have come out, it's actually going to be a much more profitable business. So even though they're targeting relatively low growth rates, I don't know, 6 to 8% a year, you would expect to get those returns as a shareholder on the costs that are coming out. It does have a market leader position. It's got a unique offering. You can't really go to someone else for a lot of the stuff that LSE Group offer. It's just some of the divisions of the business. I'm sure I could get my head. Well, I'm not sure, but I like to think I could get my head around them if I, was willing to put the time in. But from an initial glance, they just go straight in the too hard pile. If we compare that to, for example, a business that we're covering next, AB InBev, that's a much simpler business to understand. Whereas London Stock Exchange Group, I've looked at this a couple of times now. I don't really feel like I have a handle on it. And I don't feel like there's enough in there that makes me think that I could get a very good market beating return that's giving me that motivation to go in and say, well, actually, I want to understand this business better. There's nothing in there where I'm thinking, well, actually, I could be missing something. It's just, it just goes in the too hard pile. But yeah, there do seem to be quite a few people who are very, very intelligent that I know that do like this stock quite a lot. So there probably is something there for someone who is willing to jump into it a bit more. John, what are your thoughts on these results in the business?
I mean, yeah, I would agree. The results on the surface certainly seem good, but it is a difficult business to understand and not one that I do. Probably wouldn't be looking into it much further, but as you've said, I've heard a lot of people tip the stock. And it does seem to interest a lot of respected investors. So there probably is something there, but whether we get to the bottom of it or not, I don't know. Probably not willing to commit the time to it, to be honest.
No, well, that's the thing. Unless you're looking at it and thinking, well, I don't really understand this, but why the hell is it so cheap? I'm going to do a bit of digging to try and find out. That's not really the case here. It's a 23 times earnings for a business growing 6 to 8% a year. It's like, well, I'm not going to spend hours trying to figure out what it does for 6 to 8%.
Yeah.
But
how's the share price done it out of interest?
Oh, that's a good question. So over 5 years, over 10 years, it's probably like a three bagger. Over 5 years, it's up 87%. And then for the last 3 years, it's basically been flat. It's been up and down a bit, but it's up 4% in 3 years, 3% in 2 years, and 0.6% in 1 year. So,
okay, interesting. Okay. AB InBev?
Yes, a business that's much simpler to understand.
It is the world's largest brewer and owner of brands like Budweiser, Beck's, Corona, Stella Artois. The list goes on. Anyway, full-year revenues came in at $57.8 billion, reflecting organic growth of 11.2%, despite a slowdown in volumes during the final quarter. The annual increase was largely driven by price growth, although volumes are also up 2.3%. Underlying operating profit was up 5.4% to $14.8 billion. That's despite a margin decline of 1.4% to 25.6% as costs grew faster than revenues. Free cash flow was about $8.5 billion and net debt fell from $76.2 billion to $69.7 billion. For 2023, AB InBev expects underlying cash profit, EBITDA, to grow in line with its medium-term outlook of between 4 and 8%. Revenue is anticipated to accelerate faster through increases in price and volume. The board has proposed a final dividend of 75 cents per share, which is an increase of 50%. In terms of valuation, AB InBev has a market cap of 110 billion euros and trades at 18 times forward earnings, compared with a 10-year average of 20, and it has a prospective dividend yield of just under 2%. I thought these results were very good, and it is showing the value of some of those brands that it owns and some of the strongest beer brands in the world. I don't think they're quite as high quality or quite as high margin or lend themselves to premiumization as much as the brands that Diageo holds, which are predominantly more spirits, although they do have Guinness. But these are very good numbers, and I think they probably have the similar scope to try and trade up, even though people are generally drinking less. And then in terms of increasing the volumes, certainly the emerging markets, there's a lot more penetration that could happen over there. So I think there is certainly a lot going for it. 20 times forward earnings, it is expensive. It's not the most expensive business. As we saw last week with Nestle, that was more so. But I'm not sure that it's high enough quality for me to pay 20 times earnings for. What are your thoughts, Sam?
I don't like it. I think the debt's too high. So net debt of 69.7 billion, that compares to 8.5 billion free cash flow. And if we're nicer and use underlying operating profit, so not even operating profit, underlying operating profit, that's 14.8 billion. So it's over 5 times the underlying operating profit. I get uncomfortable when it's more than about 4 times the actual operating profit. So that just rules it out straight away. But then for a business with that much debt to be trading at a forward P of 17, I find quite strange. I don't know if it's because of the strength of the brands that it's got, but I just think in a rising interest rate environment as well, I'm surprised it trades at the valuation it does, because that's a lot of debt that needs repaying. And I just feel like, if you're buying these shares, you're paying quite a lot for them. And I feel like the debt holders really own the business for now rather than the shareholders. So yeah, I just wouldn't look any further based on that.
Fair enough. Okay. Final company of the week, Wendy's.
Yes, Wendy's is, you may have heard of it, but it's the American fast food chain. They recently launched in the UK as well, which I'll get into. I think I've come across one in the UK, actually. I can't remember where I saw it, but I have seen one. I didn't go in, but I don't think I've seen one in Newcastle yet.
One in Oxford.
Yeah, I know. I can't remember where I saw it, but I don't think I've seen it in Newcastle. But I would be keen to see to go and try one, actually, because I've seen Wendy's in films and stuff. So I'm on the lookout for a Wendy's. I'm a prospective customer. So Wendy's have come out with their Q4 and full year results, and their total revenues for the quarter, so for the fourth quarter, were up 13.4% to 536.5 million, and up 10.5% for the year to 2.095 billion. And all these figures are in dollars. Operating profit was up 9.2% for the quarter to 84 million, and down 3.7% for the year to 353 million. Cash flow from operations was down for the year 24.8% to 259.9 million, and free cash flow was down 19% to 213.1 million. The total revenues, they've said the increase in revenues resulted primarily from higher sales at company-operated restaurants, driven by the favourable impact of the acquisition of 93 franchise-operated restaurants in Florida during the fourth quarter of 2021, and higher same-restaurant sales. Revenue also benefited from an increase in franchise royalty revenue and advertising funds revenue, both of which were increased largely due to higher same-restaurant sales. in company-operated restaurant margin. They've said company-operated restaurant margin held flat versus the prior year, primarily due to a higher average check, offset by higher commodity costs, customer count declines, higher labour costs, and the impact of the company's investments to support the entry into the United Kingdom market. Operating profit, they've said the increase resulted primarily from higher franchise royalty revenue, the favourable impact of the acquisition of 93 franchise-operated restaurants in Florida, and higher advertising funds revenue. These increases were partially offset by an increase in advertising funds expense relating to the timing of marketing expenses and higher general and administrative expenses. And net income, they said the decrease resulted primarily from a higher tax rate, largely as a result of lapping a deferred tax benefit related to a change in state tax law, and a higher interest expense as a result of the company's debt raise completed in the first quarter of 2022. These decreases were primarily offset by an increase in operating profit and higher other income, primarily driven by increased interest income. There were a few points in the slides as well. So they've said that weekly US breakfast sales peaked at over $3,000 per restaurant in Q4. So if I do go and I like it, and hopefully I've got breakfast to look forward to as well in the near future. And they've said they opened over 275 global restaurants and grew net units by 2.1% in 2022. They've got over 300 potential franchise candidates in the recruiting pipeline, and they expect annual net unit growth of 2 to 3% in 23 to 24, and they expect that to increase to 3 to 4% in 2025. And for 2023 to 2025, they expect about 30% of the US growth to net unit growth to be US and 70% international. And they've highlighted in Europe, they're going to continue the UK build out and enter Ireland and Spain. And for Asia Pacific, Middle East, and Asia, they've said they've got large development agreements in India and the Philippines. And they're planning a substantial growth of their footprint in Mexico. And then they've said in the US, they've got thousands of potential trade areas identified. In terms of the valuation, the business trades at a PE ratio of 25.56. And it has a dividend yield of 2.39%. I think that's quite expensive. But when you look at the revenue per share, for example, from even going back to from 2009 to 2022, it's not really increased by an impressive amount. They seem to be going for the international expansion now. I think as a customer, I would like to try it. But I think I wouldn't be paying 25 times earnings for a business that's talking about growing, at say 3 to 4% a year. Yeah. I think this is a business that you would do very well to get 10% revenue growth a year out of this, and I think they will struggle to do even that. So for that, really it's not just on valuation, because I also don't really feel like I understand the business. I understand what it does. It's not a difficult thing to work out, but they just sell burgers. But having never actually been to the business, or it's not like McDonald's where I've grown up and they're all around me. I don't really feel like I know the Wendy's brand well enough either, if that makes sense.
Yeah,
I'm just not really comfortable with it. But yeah, I wouldn't be. It doesn't matter anyway, because at 25 times earnings, I wouldn't be looking any further. John, what are your thoughts on these results and the valuation?
Yeah, I would. Yeah, agree with you in terms of it's certainly not cheap, and in terms of the growth that it's been delivering. And again, it's like you, it's not a brand that I'm that familiar with, so I'd be hesitant. It's one I'd be interested in looking at further and understanding it a bit better. But yeah, the sort of those two headline things, the growth that it's been delivering and the price. I'm interested to know why it is trading as, as such a top evaluation as it is. But yeah, so probably wanted for me to at least to dig in a little bit further, I think.
Well, you could start by trying the Oxford Wendy's and let us know how it is.
I know. Well, that's what I mean. I'm curious to know what this is all about.
I have seen them popping up places. Like I saw one in Bucharest as well. I think when I was there, I'm sure I did. I can't remember where I've seen one, but I definitely. Or maybe it's in the Metro Centre. Maybe I'll walk past it in the Metro Centre.
It's not going to be one that's difficult to understand either. So
no,
you could have some fun in investigating this one.
Absolutely. So of the 6 businesses we've covered this week, Primary Health Properties, Rightmove, Persimmon, London Stock Exchange, AB InBev and Wendy's, if you had to buy one, which one would it be?
difficult. I think I probably would go for Rightmove. Persimmon's not my preferred house builder, but with that red row, possibly. But no, I think Rightmove on balance.
Without sounding boring, I would also do
Oh,
Rightmove.
no.
I think it's probably the best business. I think the valuation's fairly reasonable. It's possible LSE is a better business, but the problem is I don't understand it.
Yeah.
I wouldn't know.
Fine. Okay. Well, on that boring note, we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.